Hello learner, welcome.
Greetings and welcome back to the lesson. We in our today's lesson going to answer question 5, April 2023. The subject is ICT. Question 5A reads, highlight 5 objectives of an information system design, 5 marks. Highlight 5 objectives of an information system design. The first objective is to do with efficiency. The design should aim to improve the efficiency of the information system. The second objective is accuracy. That means the design should ensure the accuracy and reliability of data within the information system. The third objective is scalability. That means that the design should be scalable to accommodate future growth and changing business needs. Number 4, usability. The design should prioritize usability and user friendliness. Then lastly, number 5, security. The design should incorporate robust security measures to ensure the confidentiality. In other words, to protect the confidentiality, integrity, and availability of the information system. So those are 5 objectives. Number 1, efficiency. Number 2, accuracy. Number 3, scalability. Number 4, usability. Number 5, security. So let us put the objectives down. Objectives of an information design, information system design, information system design. Objectives of an information system design. What did I say? Number 1, I say number 1 is efficiency. 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 The design should aim to improve efficiency of the information system by streamlining processes, by reducing redundancies, and optimizing resource utilization. 2, accuracy. Accuracy, from the word accurate. The design should ensure the accuracy and reliability of the data within the information system, and that includes implementing data validation rules, error handling mechanisms, and data integrity controls. 3, scalability. Scalability. The design should be scalable to accommodate future features, should be able to accommodate increased data volumes and expanding user requirements without significant disruptions or performance degradation. 4, usability. Usability. The design should support user friendliness, should prioritize usability and user friendliness. It should be intuitive. It should be easy to navigate, and it should provide a pleasant user experience. The user interfaces should be designed with an end user in mind, considering their needs, their preferences, and even their skill levels. Then lastly, security. Security. The design should incorporate security measures to protect confidentiality, integrity, and availability of information system, and that includes implementing access controls, encryption, and authentication mechanisms, and also monitoring tools to detect and prevent unauthorized access or data breaches. So these are 5 objectives of an information system design: efficiency, accuracy, scalability, usability, and security. 5 objectives, 5 marks. Part B of this question reads, explain 5 possible reasons why an organization may decide to replace an information system. Reasons why an organization may decide to do what? To replace an information system. 1 is technological obsolescence. 1, technological obsolescence. Technological obsolescence. The existing information system may become outdated. It may become incompatible with new technologies. It may be incompatible with software versions or even hardware platforms, and that can limit its functionality. It can limit integration capabilities and performance, prompting the need for replacement. Number 2, lack of scalability. Lack of scalability. If the current system cannot handle the increasing data volumes or even user demands or the business growth, it may be necessary to replace it with a more scalable solution that can accommodate future needs. 3, inefficient processes. An information system may be replaced if it is unable to support or optimize the organization's core processes. And if the system hinders productivity, it may cause bottlenecks. All right? And a more efficient replacement may be sought. Inefficient processes. Integration challenges. Number 4, integration challenges. If the existing technology or information system cannot effectively integrate with the other systems or other applications or other platforms, then it may impede data flow, it may hinder communication, or even create what we call data silos. And a replacement with a better integration capabilities may be necessary to improve efficiency and collaboration. 5, cost effectiveness. Cost effectiveness. In some cases, organizations may find that the cost of maintaining and supporting the current system outweighs the benefit it provides. So if the system requires extensive customization, frequent repairs, or even expensive licensing fees, replacing it with a more cost-effective solution may be a viable option. It may be a viable option. So these are 5 reasons why an organization may decide to replace an information system. Technological obsolescence, number 1. Lack of scalability, number 2. Inefficient processes. If the current system is inefficient, if it cannot be integrated with other systems, or if the costs outweigh the benefits, then such a system ought to be replaced. Part B, that is part B of question 5, 5 marks. I'm now going to answer C. Part C. Enumerate 5 reasons why memory management is required in a computer system. Why memory management may be required in a computer system. Why memory management may be required in a computer system. The first reason is in relation to resource allocation. Resource allocation. Memory management ensures efficient allocation of memory resources to running programs or processes, and it allocates memory space based on their size requirements and optimizes memory utilization to maximize the overall system performance. So one reason why memory management may be required in a computer system is because of resource allocation. Number 2, memory because of memory protection. Memory management enables protection mechanisms to prevent unauthorized access or even modification of memory areas. Memory management ensures that each program or process operates within its allocated memory space and cannot access memory regions assigned to other programs, and that enhances security, the system of the security. All right, that is the second reason why memory management may be required in a computer system. 3, memory sharing. Memory sharing. Candidates, memory sharing, we can say, facilitates, we can say, in other words, memory management facilitates memory sharing. Memory management facilitates memory sharing among multiple processes, allowing them to access data or even code segments. And that improves efficiency by reducing duplication of memory resources and enabling what we call inter-process communication. So memory sharing is another reason why memory management may be required in a computer system. The fourth reason is known as memory allocation. Memory allocation. Point number 1 is resource allocation. Point number 4, memory allocation. When a process or program terminates or is no longer in use, memory management handles the deallocation of the associated memory. And it does that by freeing up memory space and makes it available for other processes or programs, and thereby preventing memory wastage and memory fragmentation. So memory management is required because of memory allocation. 5, memory organization. Memory organization. Now, memory management organizes what we call the memory. Memory management organizes the memory into logical units, such as pages or even blocks, and it does that for efficient data storage and efficient data retrieval. So memory management manages memory fragmentation, compaction, and swapping techniques in order to optimize memory usage and minimize performance degradation. So these are reasons why memory management may be required in a computer system. 1, resource allocation. 2, memory protection. 3, memory sharing. 4, memory allocation. 5, memory organization. 5 reasons. How many marks? These are 5 marks. That is C. D. Tujenge Limited is in the process of developing a new information system. A few managers are reluctant to embrace the new information system. Roman 1. Identify the most suitable method of system changeover to apply in the above scenario. Roman 2. Outline 4 advantages associated with the method identified in D1 above. So D1, D Roman 1. Most suitable method of system changeover. Most suitable system of changeover. Now the change is from, we read that is in the process of developing a new information system. The change is from the old system to the new system. So identify the most suitable method of system changeover to apply in the above scenario. We are told that a few managers are reluctant to embrace the new information system. So 1 method candidates to apply in this scenario. The scenario is that a few managers are reluctant to embrace the new information system. So the most suitable method of system changeover is to apply in this scenario is would be what we call the incremental changeover approach. The incremental changeover approach. The organization can use the incremental changeover approach. That means that the organization should implement the change in phases. The change should not be radical because more people or managers or employees may resist the change. So it's supposed to be gradual, it's supposed to be incremental. It has to be done in phases. So that would earn 1 mark. Where there is potential resistance to any change, then it's advisable to make incremental changes, not radical change. Don't initiate the changes wholesomely. Do it in phases, so that it can be embraced. The change can be embraced by all that are affected by the change. Roman 2, outline 4 advantages associated with the method identified in D1 above. What are the advantages associated with incremental change? Advantages, Roman 2. Incremental change over method. Advantages, this is Roman 2. Advantages of incremental change over method. The first advantage is that this approach allows for a gradual implementation of new information, and that mitigates the risk of complete system failure or disruption, or as the organization can transition to one module or even a department at a time. Incremental may mean that the change be effected, say, in one department. Could be, first of all, say, the finance department, depending on the nature or the level of resistance expected. If most resistance is being witnessed, say, in the marketing department, then the organization can gradually shift to departments that are likely to embrace the change. Could be, say, the finance department. If it has the finance department, the manager has no problem with the system, the new information system, then change can be initiated in that department first. So there is reduced risk when dealing with, when initiating change using the incremental change over method. The first advantage is reduced risk. Now, this reduced risk, I've said, is mitigated when the risk is mitigated against when the incremental changeover method is used. This method allows for gradual implementation, and that kind of change can allow the members who are resisting, the managers who are resisting, time to familiarize, or time, they can be allowed time. Over time, they may embrace the change as they see that the change is not as risky as they expected. Do you understand? This approach mitigates the risk of complete system failure or even disruption, because the organization can transition from, say, one department at a time. Instead of changing all the systems in information system in all the departments, the change is initiated in a department, one department at a time. That is the first advantage. The second advantage, user acceptance and training. User acceptance and training. Now, by implementing the new system in phases, by implementing the new system in phases, users have the opportunity to gradually adapt to the changes. And this approach allows for sufficient user training and support, and thereby increasing the chances of user acceptance and reducing resistance. Do you understand? Yes. 3, continuous operation or operations. With the first approach, or with the incremental changeover approach, the existing system continues to operate alongside the new system during the transition period, and that ensures minimum disruption to the organization's operations. That means that there is continuous operations because the new system runs parallel with the existing system, and that minimizes disruption to the organization's operations, which is a critical function that can be performed. Do you understand? This ensures minimal disruption to the organization's operations. Why? Because critical functions can still be performed using the old system while gradually transitioning to the new system. 4, flexibility and feedback. Flexibility and feedback. The first approach, the incremental changeover approach, allows for flexibility and also feedback during each phase of implementation. That means that adjustments and improvements can be made based on user feedback and lessons learned from earlier phases, and that enables the organization to refine and enhance the system as it progresses, and thereby increasing the likelihood of a successful implementation. So these are 4 advantages of incremental changeover approach. 1, reduced risk. 2, user acceptance. 3, it allows for continuous operations of the organization. Then flexibility and feedback. 4 marks. So you've done the April 2023 question 5. We'll continue to revise the other questions in our subsequent lessons. In our next lesson, we'll answer question number 6. Then thereafter, we'll answer question number 7. Thank you. God bless you. Bye-bye.
Yes, good day, my student. Welcome back to Manifested Online Classes. My name is Joseph Kimani, and in this session, or basically in this class, I want us to look on an illustration question regarding the topic of public financial statement. Remember, in our previous classes, we have already looked on how we prepare the statement of comprehensive income, statement of financial position, statement of changes in equity. And in this class, I want us to illustrate how we present the same using a past paper question. I want us to go through the question, and then from there we look on what was required. So the question reads, the following trial balance related to BD Limited as at 31st of December 2022. So we are given a trial balance for BD Limited at the end of the year. First of all, we have the property at cost, and you're told property include a building. Generally, if you're given property include land and building. So in our case, you're told the value of building is 400 million. So mean that the difference between 600 and 400 is the value of land. We have plant at cost, motor vehicles at cost, office equipment at cost, accumulated depreciation as at 1st January 2022 for buildings, plant, motor vehicles, office equipment. And then we have the inventory at the start of the year, purchases at cost, distribution cost, administrative expenses, revenue, trade receivables, and trade payables. We have the bank balance. We have the deferred tax, current tax, bank interest, and then from there we have the ordinary share capital, the share premium, the retained profit as at 1st January 2022, interim dividends paid, and then we have suspense. Then from there we have some additional information, note number 1 up to note number 6. And then what are we required? We are required to prepare the statement of, we are required to prepare the following financial statements in a suitable format for publication. In other terms, we are required to prepare 3 components here of financial statements in a format suitable for publication. 1, we are required to prepare the statement of profit or loss for the year which ended 31st of December 2022. B, a statement of changes in equity for the year which ended 31st of December 2022. And C, a statement of financial position as at 31st of December 2022. Now, before we prepare what was being required here, definitely we need to go through the additional information. We see what we are told, and equally we see whether there is any working which is required. So in additional information number 1, you are told, during the year which ended 31st of December 2022, BD Limited disposed of an item of plant for cash proceeds of shillings 20 million, which were credited in the revenue account, and we are told no other accounting entries were made. The plant had a cost of 39.7 million and had an accumulated depreciation of 15.86 million. And then in the other point, you are told any gain or loss on disposal should be included within the cost of sale. So what you are told here is that this company disposed, or in other terms, sold an item of plant at an amount of 20 million. So this 20 million, which was received from the sale of the plant, we are told it was included as part of the revenue. First of all, that is wrong, because whenever the company sells an asset, that is a capital income. It should not be included in the revenue of the company. So therefore, when preparing the statement of profit or loss, what we are going to do, from the figure for revenue, we are going to less that 20 million. 2, anytime the company disposes or sells an asset, you have to prepare an account called disposal account for you to determine whether that item was disposed at a gain or at what? At a loss. And actually, we are told that profit, all the loss on disposal should be part of what? Part of the cost of sale. So therefore, let's start with that working. Remember this illustration. This is illustration on the topic of published. So we start with the workings. We start with workings, and working 1 will be the preparation of the disposal account. I've said this is an account which is prepared anytime the company do what? Sells or disposes an asset, and we prepare this account to determine whether the asset was disposed at a gain or at what? At a loss. So how do we prepare this account? We prepare this account by debiting it with a cost, crediting it with 2 items, the accumulated depreciation and also the sales proceed. Then from there we balance our account. Any balancing figure on this side is a loss on disposal. Any balancing figure on this side is a gain on what? Disposal. So we are given those items. 1, we are told we are given the cash proceeds. The cash proceeds is the amount which was received by the company after selling that asset. And if you check on the figures given in the trial balance, our figures are given in thousands of shillings. So therefore, for us to be consistent, we have to work with all our figures in thousands of shillings. So 20 million is the sales proceeds. And then we are also told that this plant had a cost. The cost was 39,700. That is a cost. And then we also given the accumulated depreciation as 15 Okay, that is the accumulated depreciation we recorded up there. 15 what? 15,860. So what we need to do, we balance our account here, and the balancing figure, if on the debit side is a gain, if on the credit side is what? If on the credit side is a loss. Is a loss. So let's add what we have on the credit, 15,860 plus 20,000. So that will give us 35,860. So mean that this side is more, and therefore our balancing figure will be on which side? It will be on the credit side. And how much will be our loss? It will be, we take that minus what we have on the debit, 39,700, and that will give us 38 what? 40. So this particular 3840, this is what? This is the loss on what? The loss on disposal. And what you're told is that this particular loss on disposal should be included as part of the cost of sales. And basically that's what we said in our previous class, that any gain or loss on disposal should be part of the cost of what? Sales. So that will be added in the cost of sales. And equally, we have said as far as that point is concerned, there are a number of adjustments we are going to make. The 20 million, this is the amount received from the selling that particular plant. We are told it was included as part of revenue. That is wrong. We are going to less that from the revenue. And then we also told that this particular plant which was disposed or which was sold had not been accounted for. What the company had accounted for is purely the amount received. And therefore, this plant which was disposed, we are going to less it from the plant of this company. The moment the company sells an asset, disposes an asset, such an asset should be derecognized. It should be removed from the company's books of account. That was not done. So therefore, we are going to make that adjustment, but you're going to make that adjustment specifically when preparing what is required in Part C. So let's move to the last point of note number 1. And you're told it is a policy. It is the company's policy to provide a full year depreciation in the year of asset purchase and none in the year of disposal. It basically means that whenever the company has acquired an asset in a certain year, even if the asset is acquired some few months at the end of the year, the company provide a full year depreciation, but none, no depreciation which is provided in the year of disposal. Basically, that information is to help you in terms of computing the depreciation for plant in note 2, because there was this plant which was disposed during the current year. So this plant which was disposed during the current year, no depreciation will be provided as far as that plant is what? Concerned. But you're going to use that information in note 2. So let's go to note number 2. And you're told depreciation on property, plant and equipment is to be provided and allocated as follows. So let's compute those particular depreciations. As per note number 2, we compute the depreciation of items of PPE. We start by computing depreciation of the first item, which is what? Which is buildings. Buildings. So we are told buildings are depreciated at the rate of 2.5%. Using which method? Using straight line. So at a straight line, you have to recall we compute depreciation based on the cost. So what is the cost of buildings in the trial balance? The cost of buildings is 400 million. So we get 2% of 2.5% of that, 2.5% of that. And then also in note number 2, we compute the depreciation on plant, which is at the rate of 10%. Using which method? The reducing balance method. So under the reducing balance method, we compute depreciation based on what? Based on the net book value. Based on the net book what? Value. So what will be the net book value of a plant and the plant? So we take the cost, which is 280, and then we less the accumulated depreciation, which is 111, 116, 16. But now equally here, you have to remember there was this plant which was disposed. So therefore, because no depreciation which is provided in the year of disposal, we automatically need to eliminate that particular plant here. that plant here. And basically we eliminated here at its net book value. So what will be the net book value of that plant? So the net book value of this plant which was disposed will be, its net book value will be equal to its cost, which we have here, 39,700 minus the accumulated depreciation, which is 15,860. So that will give us now the net book value of this particular plant which was disposed, which was sold during the current year. We have 39,700 minus 15,860. So that will give us a net book value of 23,840. So because it's part of this and we are told no depreciation in the year of disposal, we need to deduct it there, 23,840. And basically you can see we are deducting it there at what? At net book value. So we are going to come back and compute these particular depreciations. Then let's go back to note number 2, depreciation on motor vehicles, which is at the rate of 20%, using which method? Straight lines. At a straight line, we compute depreciation based on cost. The cost of motor vehicles is 70 million. 70 million. So we will compute that. We go back to note number 2. We compute depreciation on office equipment. Office equipment, which is 12.5%. Using straight line. Straight line, we compute depreciation based on what? Based on the cost. Based on the cost. Yes. So what now we need to do? We compute these particular depreciations. And remember in our case here, what we have said is that depreciations on items of PPE, this one is included as part of the cost of sales unless told otherwise. If you go back to that particular point, you'll be able to see how those particular depreciations are supposed to be classified. For example, depreciation on building is administrative and so on. But you have said if the question is silent, you always account for this depreciation as part of the cost of sales. So let's compute this. We start with the depreciation on buildings, which will be 2.5%. 2.5% times 400,000. 400,000. So that will give us what? That will give us 10,000. Will give us a figure of what? 10,000. 10,000. And then you are told that this particular depreciation on buildings, as per note number 2, this one will be part of administrative expenses. Will be part of the administrative what? Expenses. That is important. Then let's compute the depreciation on plant. First of all, we compute this, and this was a figure of 280,000. This is a 280,000. 280,000. I hope that is correct. 280,000. Yes, we take 280,000. 280,000 minus 111, 160. 111, 160. I hope that also figure is correct. 111, 160. So and then to this we less now the net book value of the plant which was disposed, 23,840. Okay, and then we get 10% of that, which will give us 14,500. 14,500. How is this depreciation to be accounted for? As per note number 2, this will be part of the cost of sales. This will be part of the cost of sales. Then let's compute the depreciation on motor vehicles, which is 20% of the cost, which is 70, and that will give us 14,000. As per note number 2, this depreciation on motor vehicle should be classified as part of distribution cost. Part of distribution cost. Then we compute depreciation on equipment, which is 12.5% of the cost. And this will give us what? 5,000. 5,000. And equally, as per note number 2, this is a part of admin. This is part of the administrative what? Expenses. So those are the depreciations. So and I think we are done with that particular point. Let's move to point number 3. In point number 3, what are we told? We are told that it has been discovered that the former financial controller of BD Limited engaged or basically was engaged in fraudulent financial reporting of shillings 12 million of trade receivables that were non-existent and need to be written off. So basically what that means that the former financial controller of this company included in the receivables an amount of 12 million which are non-existent receivables, and therefore they need to be written off. So we are told that out of this amount, 7 million relate to the year which ended 31st of December 2022, which is now the current year, and therefore that particular amount of 7 million which relate to the current year, we are going to write it off and basically include it as an expense for the current financial year. So remember, these bad debts which are written off, this is written off as a result of a decision which has been made by the board or basically by the management, and therefore such an expense which arises as a result of a decision which is made by the management of the company, by the board of directors, then we classify that as part of administrative expenses, and then you're told with the balance relating to the prior year. So therefore, those particular bad debts which are to be written off, which are for non-existence receivables, bad debts written off, So in that case, we are told that is an amount of 12 million. Is an amount of 12 million, but we said we are working with all our figures in thousands of shillings. So we are told 7,000 relate to the current year. So therefore, in preparing our income statement, this one we are going to include it as part of admin, and then now the difference, which is 5 million. This one is a prior year adjustment. Adjustment. Basically, what that means, this amount of 5 million, it relates to the previous year. We don't include it in the income statement for the current year. It's not an expense for the current year. So what we do, we adjust it in the opening the opening retained profit or the retained earnings, because it was an amount which was supposed to be written off in the previous years, but it was not written off. So what we are only including in the income statement for the current year is 7 million. So let's go to note number 4. And in note number 4, we are told the existing debit balance on the current account in the trial balance represent the adder or over provision for previous year's tax. So if you go back to the trial balance, there is an item which you are given there, which is an item of current tax. So that item is below the bank balance, is below the deferred tax, and that item is an amount of 2600, the item of current tax, and you can see this is a debit balance. It is on the debit side of the trial balance. So this particular amount here, this one is what is under provision. Of what? Of current tax. Because under provision of current tax from the previous years has a debit balance, in the trial balance. But if it was over provision will be having a credit balance. That is something which the examiner will not tell you, but any other provision of current tax from the previous year, this one will always be having a debit balance in the trial balance, and any over provision of current tax in the from the previous year, this will be having a credit balance. This is something you'll come across in most of the questions for published, but the examiner will not have specified whether it is over or under. Is upon you to know that other provision has a debit balance, other provision has what? Has over provision has a credit balance. So therefore, that is over. That item which we have is under provision. So how do we treat under provision of current tax from the previous year? So such under provision, we bring it forward to the current year and we add it. We do what? We add it to the current year's estimated tax liability. We add it to the current year's estimated tax liability. But if it was an over provision, we bring it forward to the current financial year and we less it from the current year's estimated tax liability. That's basically what you need to know, and therefore that's what you're going to do as far as that other provision is concerned. And then you're told, number 4, the second sentence, we are told the provision for current tax for the current year, that is the year which ended 31st of December 2022, was 42 million, or was 52 million. 52 million is required, together with a decrease to the deferred tax provision of 3 million. So therefore, we are told the estimated tax liability for the current year is 52 million. So mean that we need to determine the amount of current tax to be charged in the income statement. So the amount of current tax to be charged in the income statement, what we do is that we take the current year's tax estimate, which is 52 million. But remember, in the previous year, we had other provision. The other provision which we have in the trial balance of how much? Of 26. And we have said that that other provision from the previous year, we added to the current year's tax estimate. And this will give us now a total of 54,600. So this is the amount of current tax to be charged in the income statement. In the same point, we are told there was a decrease in deferred tax provision. A decrease in deferred tax provision in the income statement, that one is accounted for as a deferred tax income. As a deferred tax income. So because it's a decrease. Just the same way how we account for a decrease in provision for doubtful debt. A decrease in provision for doubtful debt, we account for it as an income. But an increase in any provision is accounted for as an expense. So therefore, that amount of 3 million, that is a deferred, tax income. A deferred tax income of how much? Of 3 million. Remember now these two items will be adjusted in the profit before tax. That's what we said in our previous or in the introduction class, that to the profit before tax we adjust two items, the current tax and also the deferred tax income, or what? All expense. So we have that. Then let's move to the other note number 5. And note 5, we are given the inventory at the end of the year. This is now the closing inventory, no working which is required. And then number 6, you are told on that 30th of December 2022, the company directors invited the current shareholders to subscribe for a right issue on the basis of 1 share for every 5 shares which were held at an exercise price of 15. And then you're told the come right price on the last day of trading was 20 shillings per share. So, and then you're told the proceeds from the fully subscribed right issue were credited in the suspense account. So I think what we need to do there is to determine how many shares were issued by the company during the right issue. How many shares were issued by the company during the right issue. So we are told this right issue which was made by the company to the existing shareholders, it was on the basis of 1 share for every 5 shares held. For every 5 shares which were held. So what we need to do first of all is to determine the shares held by this company, not held by this company, but the shares held by the members, the shareholders of this company. How do we determine that? We take the ordinary share capital of the company, which is given in the trial balance, which is 200,000. And to determine now the shares issued by the company, we divide that with the par value. The par value is the value per share given in the trial balance, which is 10. And this will give us 20,000 shares. So these are the shares which were held by the shareholders of the company. So the company was to, during the right issue, was to issue 1 share for every 5 shares which were held. The shares which were held were 20,000. So we need to determine how many shares were issued during the right issue. We take 1 times 20,000, we cross multiply, then we divide. Divided that with what? With 5. So this will give us what? 4,000 what? Shares. And we are told that these shares were issued at an exercise price of 15. So therefore what we need to do, we multiply the 2, and basically this will give us the amount which was received by what? by the company, the amount received by the company from the right issue, which automatically this one will give us what? 60,000. Now, what you are told is that this particular amount in the last sentence of note number 6, the proceeds, the amount received by the company was credited in the suspense. Was that correct? No. Because what we know is that once the company make a right issue, the amount which was received should be debited in the bank account, debited in the bank. That entry was made, but now the company credited suspense account. Is this what the company was supposed to do? No. So because these are shares which were issued, this account is not the one which was supposed to be credited, but the company was supposed to credit which account? The company was supposed to want to credit the ordinary share capital account. The amount credited in this account is always based on the par value per share. You take the shares issued by the company, 4,000 times the par value. The par value is the amount or is the value per share we have in the trial balance, which we know is 10. So the amount to be credited in this account will be what? 40,000. So this amount of 40,000, we are going to add it to the ordinary share capital of the company. And then the amount which is above 10 shillings. You remember the shares were issued at 15. The amount which is above 10 shillings is a premium. So therefore, that would be credited in which account? The share premium. The shares issued, 4,000 times what? 5. Times 5. Times 5. So the total, which is 20,000, that is a share what? A premium. So therefore, the adjustment which will be made as far as that note is concerned is that when preparing the statement of changes in equity, to the ordinary share capital, we are going to add 40,000. To the share premium, we are going to add what? 20,000 in relation to these particular shares which were issued by the company during the current year. And I think we are through now with the notes. What we need to do, basically we can proceed and prepare what is required. So let's start with the part A of that particular question. And what is required is the statement of profit or loss. So first of all, we need to have the name of the company. The name of the company is BD Limited. And this is a statement of a profit or loss. Statement of profit or loss for the year which ended 31st of December 2022. 31st of December 2022. So that is basically our title there. Our title. And then now we have to use the format which I gave you. Remember, I gave you the format for this. That is the exact format we use here. So, and remember, all our figures are in thousands of shillings. And here we only have one word, one column. So what do we start with here? We always start with the revenue. The revenue. And the revenue is something which is given in the trial balance. The revenue for this company in the trial balance is given as a figure of what? As a figure of 11,23,500. But remember, there is an adjustment which you're going to make here as far as note number 1 is concerned. So this plant which was disposed by the company, we are told this amount which was received, the sales proceeds, this was included as part of the revenue. Yes, so to this figure, we need to less 20,000, which was included here as the amount which was received from selling the asset. That amount should not be recognized as a revenue because this is basically a capital income, a capital revenue. So any amount realized from the selling an asset should not be included here. So I think that now will give us a figure of what? A figure of 11,03,500. So, but we can confirm that. Let's confirm whether that is correct. So we have 11,23,500 minus 20,000. Minus 20,000, that will give us 11,035,500. And then to this, what do we need to do? We need to less the cost of sales. We need to less the cost of what? The cost of our sales. Cost of our sales. Now, are we given the cost of sales? No, we have to compute it. Remember, I gave you the formula for computing this. We take the opening inventory plus purchases minus closing inventory plus any depreciation plus any loss on disposal minus any gain on disposal. So what we include here, one is the opening inventory, which is given in the trial balance, 138,000. To this we add purchases, which is just below the opening inventory, which is 667,000. To this we less the closing inventory. Where do we have the closing inventory? Note addition information number 5, which is an amount of 85,000. And then to this we add any loss on disposal. Remember here we have a loss on disposal, which is 3840. And any depreciation on PP. We have various depreciations here, and part of them should be included as part of the cost of sales, starting with the depreciation on plant, which is 14.5. Do we have any other depreciation which should be included as part of the cost of sales? No. So that's how we are going to arrive at the figure for the cost of sales. Opening inventory, purchases, closing inventory, loss on disposal, and then the what? And then this depreciation on what? On plant. So let's get the final figure here. We get the final figure. So we have what? We have 138,000. 138,000 plus 667,000 minus 85,000 plus 3840 minus 14,500 minus 14,500, and that will give us a figure of what? It will give us a figure of 709,340. 709,340. 709,340. So we less that from our revenue up there, and whatever you get here is the gross profit. The gross profit. So how much will be our gross profit? We deduct that from 1103 500, and this will give us a 598,990. That is our gross profit. So to this gross profit, next we said we add other income. So when checking for other incomes, what basically you do, you go back to the trial balance and you check other incomes on the credit side. All incomes, they have a credit balance. So we go through the items on the credit side of the trial balance. We see whether we have any other income. Up there you can see we have accumulated depreciations. Those are not incomes. Down here we have revenue, payables, bank balance, and then deferred tax. And then we have ordinary share capital, share premium, retained profit, and down there we have what? Suspense. So basically in our case here, we don't have any other income. We don't have any other what? Any other incomes. We don't have any other what? Income. So then to this we go straight to deducting our expenses. Our expenses, we can start with just what we have in our trial balance. Below the opening inventory and purchases, we have the distribution cost. Distribution cost. So the distribution cost in our trial balance is given as an amount of 44,000. So there are some depreciation which are part of the distribution, and that is the depreciation on what? On motor vehicles. So that one we included here, and that is an amount of depreciation on motor vehicles is an amount of 14,000. 14,000. So this will give us a total of 58,000. So below the distribution we have the admin expenses, administrative expenses. So equally that need to be adjusted. We can do our adjustment with here. So we have 93,500. So then we need to include the depreciation on what? On buildings, which is 10,000. And then also this depreciation on what? On office equipment, which is 5,000, which is 5 what? 1,000. There is something you should also, we also need to remember to include here. There was this bad debt which was to be written off and which related to the current financial year. The amount of how much? 7,000. We said it should also be part of administrative expenses. Yes. So I think now we can get the total administrative expenses, we have 93 500 plus 10,000 plus 5,000, or we can just take 5,000 plus 7, which will give us a total of 12. Yes, and that will give us total administrative expenses of 115 500, 115 500. And then below the administrative expenses, I think we have revenue. Okay, we have trade receivables, bank balance, deferred, current, and then we have the bank interest. Now this bank interest will be included here, but we include it here as part of the finance cost. And I think this is the only item which will form part of the finance cost, and that is an amount of how much? That is an amount of 24. 24. And then now what we need to do is we check whether we have any other expense, or this company had any other expense which has not been classified as part of cost of sales, distribution, admin, or what? Finance. So we just go through the trial balance and we check the items which we have on the debit column, because all expenses, they have a debit balance. So first of all, up there we have assets. Those are not expenses. Down there I can see inventory, purchases. Those are not expenses. We have already captured distribution, admin. Down there we have receivables, that is an asset. Down there we have current tax. Remember that was under provision. That is not an expense. Bank interest, we have already captured that there in our income statement as what? As finance costs. And then down there we have interim dividend. So basically that is not what? An expense. And I think then what we have in the additional information, number one, we had the loss on disposal. We have already captured that as part of cost of sales. Note 2, we have these 4 depreciations. Depreciation on buildings, that was supposed to be included as part of what? Admin. We can confirm whether this has been included as part of the admin. 10,000 is there. Then depreciation on plant is part of the cost of sales. Have we included that here? Yes. Motor vehicles, its depreciation is part of distribution. 14,000. Have we included as part of the distribution? Yes. Office equipment, its depreciation is part of admin. 5,000. Has it been included as part of that? Yes. Okay. And then number 3, we have this amount to be written of 7, which should be part of admin. Have we included that there? Yes. And then number 4 is about tax, current and deferred. That will be deducted from our profit before tax. And then number 6 is all about, number 5 is about crossing inventory. We captured that there. Number 6 is about light issues that do not affect our what? Expenses. So basically what that means is that we don't have any other expense. We don't have any other expense. So what we need to do here is we get the profit before tax. The profit before tax. Our profit before tax will be, we take now the total incomes minus the expenses there. So we have 598 990 minus 58,000 minus 115 500 minus 2400, and that will give us a figure of what? A figure of 423,090. So that is a profit before tax. And then to this we need to less what? We need to less the income tax expense. Income tax what? Expense. And for the income tax expense, this comprises of 2 components of tax. The current tax. And the current tax, we computed that figure there, which is 54,600. And then we also have the component of deferred tax. What did we have here? We had the deferred tax income. Deferred tax income. And because this is an income, a deferred tax income, we don't less it from our profit, but rather what we do, we add it. That's why we refer to it as a deferred tax what? A deferred tax income. So we take our figure here, which is 423,090 minus 54,600 plus 3,000. And that will give us 371 for what? 490. So what is this? This is the profit for the year. The profit for the year. So to this profit for the year, we said then we proceed and we add other comprehensive incomes. Other comprehensive what? Incomes. Other comprehensive incomes, we said these include revaluation gain or loss on PPE, revaluation gain or loss on a financial asset at fair value through other comprehensive income. But if you check on what we have in this particular question here, we don't have any other comprehensive what? Income. So basically what that means is that our total comprehensive incomes will be the same with the profit for the year, 371 for what? 490. So basically that is it. That's what was required as far as Roman 1 of that question is what is concerned, or part A of that question is concerned. So let's move to part B of that question. Part B, the examiner was requiring the preparation of the statement of changes in equity. Statement of changes in equity for the year, which ended 31st of December 2022. Now, remember, we say that this is prepared basically to show or to explain why there was a change in the various items of what? Of equity. In preparing this statement, we have said we start with the details column, and then we identify the items of equity our company had during that year. So items of equity include ordinary share capital and items of reserves. So if we go back to the trial balance, I think from where we have ordinary share capital, that is the first item, share premium, the second one, retained profit, that is the third one. Do we have any other like general reserve and revaluation reserve? No. So mean that in our case, we only have 3 items of equity, and then automatically we need to have what? We need to have the total what? The total column. The total column. So let's have those columns here. We have those columns here. I've said we have, we're going to have a number of columns. The first one will be the details column, and then ordinary share capital, share premium, and then retained what? Retained profit, and then the total column, Also our figures here, we indicate they are in thousands of shillings. So what do we start with here? We always start with the opening balances. Balances brought down. So the balances brought down, these are the figures we have in the trial balance. For ordinary share capital, the opening balance was 200,000, share premium 50,000, retained profits 223, 640, 640. Then what we need to do, basically we get now the totals. So we have 200,000 plus 50,000 plus 223, 223, 640, and that will give us a total of 473, 640. And then what we need to do is basically to take into account the transactions which occurred during the current year and which affected those items. The first adjustment which we need to make to this particular retained profit is what we were given in the additional information number 5. not number 5, but note number 3, in relation to these particular bad debts, which was supposed to be written off, which related to the prior years. Remember, we said that this is a prior year adjustment. So therefore, the first adjustment we make is to adjust this opening balance with the prior year adjustment. We say that the prior year adjustment, these are the adjustments which were supposed to be factored in, to be taken into account in the prior years, in the previous years, but they were not taken into account. Remember, this amount of bad debts was supposed to be written off in the previous year, but it was not written off. So what we do is that we deduct it from the opening retained profit, from the opening retained profit. And then from there, we take into account the transactions which occurred during the current year. I think we can start by taking this right issue. This right issue. The right issue 1, we said we need to add to the ordinary share capital, we add 40,000 because this amount was not accounted for, but it was credited in the suspense. And then to the share premium, we add what? We add 20. So that will give us a total of 60. We take it to the last what? To the last column. What else do we need to capture here? The profit for the year. The profit for the year here. The profit for the year. That will be added to the retained earnings at the start. And the profit for the year is 371,490. And we take it to the last column there. Yes, that's what we have. What else do we need to capture here? In the trial balance, we have some interim dividends which were paid. So basically, we know that dividends are paid from the profit, and therefore we need to less them here. So the interim dividends paid as per the trial balance were 10,000. So we less them here, and also we take that to the last column. Do we have anything else we need to capture? We need to take into account here from the trial balance. Okay, from the additional information, note 1, note 2, note 3, note 4, note 5, note 6, note 7. Yes, I don't think we have anything else. So what we need to do here is basically to get now the balances carried down, and we say that these are the balances now which we transfer to our statement of financial what? Position. So let's get those balances. The ordinary share capital here, the balance at the end will be how much? Will be 240. 240. What about the share premium? It will be 70,000. 70,000. What about the retained earnings? The retained earnings, the opening balance is 223, 640, minus 5,000, plus 371, 490, which is the profit for the current year, minus the interim dividend, which is 10,000. So that will give us what? It will give us 580, 130. And then we get now the total there. The total you can use, you can work out all that, or you add across. So let's just add across, and then we will confirm whether it is correct. So these we add 70,000. We add 240,000. 240,000. 240,000. 240,000. Yes, so this will give us what? This will give us 720. 720, 130. Maybe we can work this downward. We see whether that is the same figure we're going to have. 473, 640, minus 5,000, plus 60,000, plus 371, 490, minus 10,000, minus 10,000. Is that what you're going to get here? No. So let's I'm getting a figure here of 890, 130. So basically we can confirm again. So let's take 240,000 plus 70,000, 70,000, plus 580, 130, 130. Yes, the correct figure should be this one. So So that is 890, 130. Yes. So basically that is our statement of what? Changes in equity. Our statement of changes in what? In equity. And basically that what was required in part B. Remember this is part B, not part A. Part B. So then finally, we prepare now the statement of financial position. Statement of financial position. Position as at 31st of December 2022. 31st of December 2022. 31st of December 2022. So this is quite simple because we have most of the items to be included here. For example, we have all the items of what? Items of equity. So when preparing the statement of financial position here, we said we start with the assets. First of all, we record the non-current asset and then current what? Asset. So what we start with are the non-current assets. The non-current assets, we need to have a single column here, and also we have to indicate that all our figures are in thousands of shillings. All our figures are in thousands of what? Of shillings. So these are non-current what? Assets. Non-current assets. So what we start with here, definitely we're going to start with the PPE, the property, plant and what? Equipment. And in our case here we have various items of PPE. We have property, we have plant, we have motor vehicle, we have office what? Equipment. So what we need to do as far as those items of PPE are concerned is we compute their total net book value at the end of what? Of the year. And basically we include that here as a single figure of what? The PP. Remember what you have said here is that when preparing a statement of financial position for publication purpose, you don't record those items here separately. For example, you compute the net book value of plant, we include it here separately, plant the same. No, we don't do that. In fact, in an exam situation, if you do that, those items will not be marked for you. So what you do as far as the tangible and current asset are concerned, you compute their total net book value, all of them, and then you include that here as PP. As what? A PP. So let's start with the property. Property, the cost is 60. And because this property include building, we have now to less the accumulated depreciation of buildings at the start of the year. Or basically, we have to less the accumulated depreciation for buildings at the end. So what would be the accumulated depreciation for buildings at the end of the year? Accumulated depreciation at the end of the year. So in terms of how we compute this, we take the accumulated depreciation at the start, which is part of the trial balance, or which is in the trial balance, and then we add the depreciation for the current year. The depreciation for the current year for buildings is how much? Is 10. So this will give us a total of 90. So we let's start now from the cost. From the cost. Then to this, we add plant. Plant, that is, the cost is 2 what? Is 280. And then what will be the accumulated depreciation of plant at the end of the year? We take the accumulated depreciation of plant at the start as given in the trial balance, 111, 160, and then we add the depreciation for the year here. How much is it? 14.5. 14.5. So this will give us an accumulated depreciation of what? It will give us accumulated depreciation of 125, 560. So let's just confirm that. We confirm whether that is correct. That addition is correct. We have 111, 160 plus 14, 500. So which will give us a total of 125, 560. Yes. So we less it here. 125, 560. But also, as far as the plant are concerned, we have to remember something. There was a plant which was disposed, and that plant is part of this. So what we need to do, the plant which was disposed, we need to less it from this net book value which you are going to get. Can you remember the net book value of this plant which was disposed? I think we can compute its net book value. Its net book value will be 39,700 and then minus accumulated depreciation. It's accumulated depreciation of 15,860. So therefore, its net book value was 23,840. So what we have deducted here is the plant which was disposed because it was not accounted for. So then from there, we add the net book value of motor vehicles. So what will be the net book value of the motor vehicles? We take the cost, which is 70, and then equally we compute the net book value at the end. The net book value at the end will be equal to the the accumulated depreciation at the end will be equal to the accumulated depreciation at the start, 42, and then to this we add the depreciation for the current year. How much is it? 14,000. 14,000. So that will give us a total of 56,000. So we less it from the cost, which is coming to 56,000. We less it from the cost. And finally, we add office equipment. Office equipment, the cost is 40. And then we compute the accumulated depreciation at the end for office equipment. The accumulated depreciation at the start, as given in the trial balance, is 15. What about the depreciation for the year? 5. So the accumulated depreciation at the end for office equipment is 20,000. So we less that now from what? From the cost of 20,000. Yes, so that basically how we compute what? The net book value for the property, plant and equipment. Remember, property, plant and equipment here, these include all tangible and current assets. So let's work out that. We have 600,000 minus 90,000 plus 280,000 minus 125,560 minus 23,840. This is the plant which was disposed, plus 70,000 minus 56,000 plus 40,000 minus 20,000 minus 20,000 minus 20 what? 1,000 minus 20,000. So I think we can confirm that working so that we get the correct figure. Let's confirm that. So the first figure is 600,000 minus 90, that is okay. And then plus 280,000 minus 125,560, 125,560 minus 23,840. Plus 70,000 minus 56,000 plus 40 minus what? Minus 20. Yes. So I'm getting a final figure here of 674 600. Yes, so that is the final figure for the PP. And then here we said we check for other assets like intangible asset, the investment, and so on. So let's go back to the information which we have in the trial balance. I think in the trial balance we have already captured the first items of PP: property, plant, motor vehicle, office equipment. Below that we have accumulated depreciations. And then we have in opening inventory, purchases, distribution, admin, revenue. We have already captured all those particular items here. Trade receivables, trade payables, those are items of current asset and current liabilities respectively. And then that bank overdraft, that bank balance, you can see that is an overdraft because the balance is on the credit side, is still a current liability. Deferred tax, that is an item of non-current liability. Current tax, we have already captured that. Bank interest, we have taken into account that. And then ordinary share capital, share premium, retained profit, all those are items of equity. Interim dividends and suspense, I think we have already captured all those. So basically it means that we don't have any other item of what? A non-current asset. So what we need to do is we proceed and record now the items of current assets. So let's record current assets. Current what? Assets. So for current asset, we have a number of items. In the trial balance, we have a trade receivables. Now the trade receivables in the trial balance is given as a figure of 74,500, but this figure will need to be adjusted with this particular amount of 12 million, which was included as part of the receivables, but you're told those receivables are non-existent. So we reduce our receivables with an amount of what? 12. So we deduct 12 here, which will give us 62,500. Okay. And then from there we check whether we have any other item of current assets. So the bank balance which you're given in the trial balance, you need to know that that is a bank overdraft because it is on the credit side. The examiner will not tell you that, is upon you to know that that is a bank overdraft and therefore is a current liability. Yes. In the trial balance, we don't have any item of current asset. What about the additional information? Number 1, you have dealt with that. Number 2, 3, 4. In note 5, we have the closing inventory. The closing inventory is included here as part of a current what? A current asset, which is 85. And then I think we are through. Yes, we don't have any other item. So what we need to do now is to get the total assets. To get the total what? The total assets. So let's add these particular items and PPE, and then the 2 items of what? The 2 items of current liabilities. So we have 674,600 plus 62,500. 62,500 plus 85,000 plus 85,000. So that will give us total asset of 822,100. 822,100. And then from there, we proceed and record what? Equity. Now for equity, this is quite simple because we have all the items of equity to be included here. From where? From our statement of changes in equity. So we just need to copy paste those items here. We start with ordinary share capital. Ordinary share capital, the balance at the end of the year was 240,000. We have share premium. Share premium. The balance at the end of the year for share premium is what? 70,000. 70,000. Then we have the retained profits. The retained profits at the end of the day, it was 580, 130. And now what will be our total equity is what we have here. Total equity. Total equity. Total equity is what? Is 890. Is 890, 130. 890, 130. Okay. So then from there we proceed and we record the non-current liabilities. The non-current liabilities. Non-current liabilities. So which non-current liabilities do we have here? So for non-current liabilities, we say these include things like the bank loan, things like debentures, redeemable preference shares, and maybe something like the deferred tax. So what we need to check are the non-current liabilities which we have here. And in this question, we don't have bank loan, we don't have debentures, we don't have redeemable preference shares. I think in our case, we will only have one non-current liability, and that is the deferred tax. And the deferred tax which we include here, first of all, if we go back to the trial balance, we are given a deferred tax of 32,400. But remember what you are told in note number 4, that the deferred tax provision is to be reduced with how much? With 3 million. So therefore, the amount of deferred tax to be recorded here, the amount of deferred tax which will be recorded here as a liability, we take the amount given in the trial balance, which is 32,400, and then we reduce this with how much? We reduce that with 3 million. So this will give us what? This will give us 29,400. 29,400, and equally we can confirm whether that is working is correct. 32,400 minus 3,000. Yes, that will give us 29. 400. So do we have any other non-current liability? I don't think so. We don't have any other non-current what liability. So finally, what we need to record are the current liabilities. Current liabilities from the trial balance. We have what? Remember, the liabilities have a credit balance. So check the items on the credit side. So one, we have the trade payables. The trade payables. The trade payables is an amount of 68,800. Then below that we have the bank balance, or basically the bank overdraft. The bank overdraft, and the bank overdraft is 15,500. 15,500. Yes, I think those are the two items which we have in the trial balance here. In the trial balance, and then in the additional information we check whether we have any other item of current liability. Note 1, we don't have any item of current liability. Note 2 is about depreciation. Note 3, and then note 4, we have the current tax for the current year. The current tax. So that tax, remember, had not been paid, and you are told in this case the company was supposed to pay, or the estimated tax liability for the current year was how much? Was 52. That's what we include here. Yes, and then note number 4 is about note 5 is about inventory. Note 6 is about what? About now the right issue, the amount of what? The right issue. So I don't think we have any other item of current liability to be included here. So what we need to do here is to get the total equity and liabilities, the total equity and liabilities. But there is something we need to adjust here. There is something which we added longly, because if you take on what we got here as the total equity, definitely you'll be able to see that that is more than total asset, which is basically long. So the figure which is wrong is this figure for retained earnings, or basically the retained profit. So there is something we added longer here. We need to make some changes quickly. So what do we have here? We have 138,000 plus 667,000 minus 85,000 plus 3840 plus 14,500. So that will give us what? That will give us 738. So this figure, instead of adding what we did, we deducted, which was actually long. So the correct figure here should be 738. 738 what? 340. So then we get the correct figure for the gross profit here. That was an error. So let's get the correct figure for the gross profit. We deduct that from our revenue, 1103,500, and that will give us now the correct figure for the gross profit here to be 365, 160. So what else do we need to change? Our profit here before tax. Our profit before tax. So our profit before tax, we take 365, 160, minus now the three expenses, 58,000, minus 115, 500, minus 2,400, 2,400. So that will give us a figure of what? 189 to what? 260. And then we less the current tax, which is 54,600 plus the deferred tax income of 3,000. Yes, and our correct figure here for the profit for the year would be 137,660. Equally, that will be the total comprehensive income there. Yes, so that was basically a small addition, a mistake or error So we also need to adjust this figure for the profit for the year, because the correct profit for the year is how much? Is 137, 660, 137, 6 what? 60. So meaning that this will also change here. This will also change here. Those two figures will change. So let's work out this. The retained profit at the end of the year. So we take the opening balance here, 223, 640, minus 5,000, which was the prior year adjustment, plus the profit for the year 137, 660, minus the interim dividends which were paid of how much? 10,000. 10,000. So that will give us a figure of 346, 300. Yes, and then we get now the total equity there. So we can work out that we take 346, 300 plus the 70,000 which we have here, plus 240,000. 240,000. So that will give us now the correct figure here of 656, 300. So therefore here we equally need to change this figure here. The retained earnings at the end, the correct figure is what? 346, 300. And the total equity as per our statement of changes in equity is 656, 3 what? 300. I think now we can get now our total equity and what? Liabilities. So our total equity is 656, 300, plus now the deferred tax 29, 400, plus the payable 68, 800, 68, 800. I hope that figure is correct. Yes. Plus the bank overdraft, which is 15, 500, plus the current tax 52,000, 52,000, 52,000, 52,000. So let's take that again. We start from equity there, 656, 300, plus 29, 400, plus 68, 800, plus 15, 500, plus 52,000. 52,000. Yes, that will give us what? That will give us a figure of what? A figure of 822, 100. 822, 100. 822, 100. Yes, yes, yes. So basically that is it. That what was required as far as that question is concerned. That was an illustration question on the topic of what? A published financial statement. So basically that brings us to the end of that particular class. We meet in our next class as now we look on how we prepare the statement of cash flows. Remember what so far we have covered here is the preparation of the statement of comprehensive income, statement of changes in equity, statement of financial position, and then what is remaining is for us to discuss something to do with the statement of cash flows, the presentation of the same, and so on. So see you in the next class as we look on that.
Hello everyone and welcome to the lesson. The subject is Advanced Auditing and Assurance. Today we are going to start revising the paper that was done in December 2023 by the CPA Advanced Level candidates. This question paper has 5 questions. Candidates were required to answer all questions, and we will be answering a question at a time. In our today's lesson, we'll answer question 1. In our next session, we'll answer question 2 until we complete the 5 questions. I urge you to attempt the questions before attending these lessons. Make sure you do the questions on your own before coming to this revision session. So let us begin by answering question number 1, which reads, Part A, You are the audit manager of Baraka and Company LLP, who are the auditors of Miradi Limited for the year ended 30th June 2023. The company has net assets of 150 million. The audit has been completed, but there is a matter that has not yet been resolved on depreciation of buildings. The directors of Miradi have resolved that depreciation on buildings will not be provided for in the financial statements. The buildings were acquired in the year 2020 and no depreciation has been provided since. Required Roman 1 describes 6 additional audit procedures and actions that you would take with respect to the above matter. So candidates, here is a problem with the Baraka, Miradi Limited. This is a company that whose net assets are valued at 150 million. But the item on depreciation, we learned that depreciation has not been provided for on buildings since the buildings were acquired in the year 2020. Candidates were required to describe 6 additional audit procedures and actions that could be taken in respect to the above matter. So let us put down the audit procedures, additional audit procedures. This is December question 1. A, Roman 1. What are the additional audit procedures that the auditor should perform in respect to buildings? Now, candidates, the first audit procedure is to review the accounting policies. The auditors should review the accounting policies of this company, the Miradi Limited company. The auditors should conduct thorough review of Miradi Limited's accounting policies related to depreciation, specifically focusing on the treatment of buildings. The auditor should evaluate, in carrying out the review, the auditor should evaluate the consistency of the policies with applicable accounting standards and also the regulatory requirements. Review of accounting policies, because candidates, every company must have accounting policies on different matters. For example, on the estimation of depreciation, company must have accounting policies in relation to depreciation. And therefore, given that there is a problem on the buildings, we've read that the audit has been completed, but there is a matter that has not been resolved on depreciation of buildings. So as the auditors ought to review the accounting policies related to buildings. And in reviewing the accounting policies on buildings, the auditor should evaluate the consistency of the policies with respect to accounting of or treatment of the depreciation on buildings. 2, assessment of the methodology on depreciation. Assessment of depreciation, let me call it depreciation methodology. The auditor should assess the methodology on depreciation. The auditors ought to evaluate the appropriateness of the depreciation method that is applied to buildings. This means assessing whether the straight line method is reasonable or any other method of depreciation. So there are the various methods that the company may use. The straight line method or reducing balance method. So the auditor should evaluate the appropriateness of the method that is used to depreciate buildings. Assess, for example, whether straight line method is reasonable or not. The auditors may also consider alternative methods and their potential impact on the financial statements. There are various methods: the reducing balance method, the straight line method, and so on. Assessment of depreciation methodology. 3 is another audit procedure is in relation to documentation. Inspection, let me call it inspection. The auditor should inspect the documentation related to buildings, of building documentation. Inspection of building documentation. The auditor ought to physically inspect the documentation related to buildings, including purchase agreements, title deeds, and any other relevant contracts. And by so doing, the auditor can verify the accuracy of the acquisition costs and also ensure that no impairment or changes in the useful life have occurred since acquisition. Inspection of buildings documentation. You understand? That is, if the building was bought, then there has to be agreements. If the buildings were constructed, then there are documents related to construction of buildings. So the auditor should inspect the documentation related to buildings. Whether the buildings were bought or even constructed by the company, there are various documents that ought to be inspected, like the title deeds, the relevant contracts, the purchase agreements, and so on. So candidates, we are discussing the additional audit procedures that the auditor should carry out in relation to building of Miradi Limited, a company that has refused to depreciate buildings. We read from the question that the audit has been completed, but there is a matter that has not yet been resolved on depreciation of buildings. The directors of Miradi Limited have resolved that depreciation on buildings will not be provided for in the financial statements. So what audit procedures, additional audit procedures, should the auditors perform? The fourth audit procedure is evaluation of maintenance expenditure. You understand? Evaluation of maintenance expenditure or expenditures. The auditor should evaluate the maintenance expenditures. The auditor should review the company's records of maintenance expenditure that is incurred on buildings since acquisition. We saw that these buildings were bought in the year 2020. The auditor is carrying out the audit in the year 2023. So since 2020, what are the maintenance costs related to buildings? The auditor should assess, should evaluate, should review the company's records of maintenance expenditures incurred on the building since acquisition in the year 2020. The auditor should assess whether there are significant repairs or whether there have been improvements that have been capitalized, or whether there are any improvements since the buildings were acquired. Assess whether any significant repairs or improvements have been capitalized, and whether the expenses have been appropriately distinguished from maintenance costs. You understand? Because there are certain costs that are incurred on buildings that ought to be capitalized. Other expenses on buildings may be part of the normal expenses of for the company. So that assessment has to be done, and the auditor can only do that after evaluation of the maintenance expenditures. 5, comparison. The auditor can do a comparison with industry standards. What are the industry standards? That means that the auditor should do what we call benchmarking. Benchmark the company's depreciation policy and practices against industry standards and norms, and consider factors such as the average useful life of the buildings in the industry sector and also the common depreciation rates used by peer companies. So this is Miradi Limited. We are not been given information on the industry in which this company operates, but whatever industry it is, whether it is a banking industry or agriculture industry or whatever industry, the auditor should benchmark the practices within the industry vis-a-vis what the company is currently doing in relation to buildings. What are the depreciation policies? What are the practices in the industry? And what are the standards? What are the norms in the industry compared to what the company is doing? Because industries may have certain average useful life for buildings. The companies may have a common depreciation rates that are used within that industry. So the auditor should compare the rates, should compare the various factors in relation to buildings compared to what happens in the industry. So comparison with industry standards. So this is an additional audit procedure. Another procedure is in relation to communication with third parties. Communication with third parties. These third parties could be experts or independent appraisers, industry experts, and so on. The purpose for this procedure is to obtain their opinion on the appropriateness of the company's depreciation policy and the condition of buildings. Do you understand? These are third parties, like experts, appraisers, and so on. Communication with